Okay, well, welcome to DLA Markets, and this is your weekly update that I've been starting. I've done this for several weeks now, and I'm going to continue it for as long as my schedule permits. And on these types of live streams, I'm talking about what happened in the markets and some of my thoughts regarding the market action and what's been going on in the stock and the bond markets. Okay. And let me say at the beginning, if you get value out of this stream at any point in time, please don't forget to like and subscribe and hit the bell so you can be notified when I come out with other videos on this channel. We talk about investments and we talk about the markets and we talk about everything you need to be a better and hopefully richer investor. Okay? Well, to sum it up, the markets had a pretty good week this week. All of the indices, all the major indices were up. The Dow was up over 1 percentage point. The S&P was up about 2%, and the NASDAQ was up about 4.5%. Okay, so it was a pretty decent week compared to last week. And a lot of the sentiment in the market and a lot of the feeling in the market seemed to be centered around this expectation that's developed recently that we're either in a recession or we're going into a recession. And the result of that thinking is basically what I've been talking about for a number of weeks, is that the market believes that the Fed will basically back off of its money tightening and interest rate raising once it perceives that the economy is slowing significantly. Okay, so naturally people think when things start pointing to a recession, they think that the Fed will back off of the money tightening and the interest raising, and that is, in the bizarre, convoluted way that Wall Street thinks, that is actually a positive. Okay, so that's why the market, and particularly the NASDAQ, went up this week. Also in the bond market, you saw a rather dramatic rise in yields. The 10-year Treasury bond went up about 28 basis points. It went from 275 last week at one point up to about 3.08%. So you're seeing the bond market yields go up at the same time that the stock market showed some improvement. Okay, pretty interesting. Now, this recession fear that we've seen is really coming to the fore, and people are really starting to think that we're either in a recession or there will be a recession. And nowhere can that be seen more readily than in commodities, right? And it kind of makes sense if you think about it. Commodities are sort of a proxy for demand in the economy. When commodity prices are high, the perception is that there's a strong demand in the economy. When they go lower, it would indicate less demand and a recession. Take a look at this chart, for example. Here we have copper, which is the best known industrial metal and really a barometer of economic activity. You can see this dramatic drop in copper since June, since the beginning of June. Okay, rather dramatic drop, and you've seen that in a number of different areas. Okay, another area where you've seen it is oil. Okay, and you can see here oil. Although oil has, I don't know why it's saying that. Let's see. Should be a WTI. I don't know why. Let's see if we can change that. Okay, there we go. Wait for that to come up. But anyway, WTI now is a little over 104, but there has been a dramatic drop from earlier. It was up to 120 a couple weeks ago, and now it's down significantly, almost 20%. So you can see that that the commodities, and this runs all the way through the entire commodity complex. You see it in tin, you see it in lead, you see it in all of the different industrial metals, and I won't show you all the charts, but it's pretty evident that that's what's happening, and as a result, you've seen declines in pretty much across the board in those metals. Okay, so this has been something that I have been predicting for many months in terms of a recession. You can't have incredible rates of inflation. Now 8.6%. It's expected when the print comes out next week. It's expected to be potentially 9% plus. If that happens, that's going to be really bad for the market. But you can't expect inflation to be this high, have the Fed tightening, have the Fed raising interest rates, having the Fed reducing its balance sheet, removing liquidity from the system, and not have there be some kind of a slowdown. The debate, of course, is a soft landing versus a hard landing. I've said I'm more toward the group of a hard landing because I don't think the Fed can fine tune it to that extent. But whatever happens, I think there will be an economic slowdown. I think even though the employment numbers came out strong today, 372,000 new jobs created in June, that was a very strong number. And in the beginning of the day, that caused some trepidation. People weren't sure which way to go on that one because, again, in the mind of Wall Street, a strong employment number could mean that the Fed will be more prolonged and more aggressive in its tightening, and therefore that would be a negative in the market. And I think if you continue to see further strength in the economy, you will see further sell-offs. But all of this, regardless, it's all occurring within a bear market. The slight rally we had this week, I think, was a rally within a bear market. So absolutely no change in my outlook on that. I expect stocks between now and certainly the fall to be lower. I think the fall period of September and October is going to be particularly ugly. And I see the fact that within the next couple of weeks, you're going to start having earnings revisions downward. And I've expressed on this channel many times, but I'll do it again here, that you cannot have such high levels of inflation with the prices of virtually everything going up in our economy and not have margin compression and extreme pressure on earnings, which in my mind has not been fully reflected in the market yet. And I think you're going to start seeing that within the next couple of weeks as earnings roll in. But we'll continue to talk about that. Now, one thing I really wanted to touch upon in this live stream is the question of energy demand and oil and gas, and where we are in particular with respect to Exxon, Chevron, Occidental Petroleum, some of the stocks that we've been recommending on this channel for some time, going back to March of 2020, when Exxon was selling for $33 a share. I've been bullish on the energy sector in general since that time. I've chosen Exxon and Chevron as my way to play it. It's so far been very successful. But at this point in time, when you're really looking at the economy slowing markedly, it really begs the question, where are we here in the cycle? And, it really causes one, if you have a large exposure to energy like I do, and perhaps some of my subscribers do, you really want to ask yourself, is the softening in the economy really going to affect the basic thesis that got us into these names to begin with, okay? And what I want to talk about in this live stream is I want to talk about what's going on in Europe, because us in the US, we have a tendency to be insular. We have a tendency to focus on the US domestic situation, and the focus has been this week, of course, in the US potentially having an economic slowdown. What you really need to understand, and what I've really delved into myself, is you really need to understand what's going on in the rest of the world, and as it relates to energy, more specifically, Europe. Okay? Now, everybody knows about Russia's invasion of Ukraine and the world's reaction to it with respect to the embargoes, and all of the pulling away from Russian oil and gas that the whole world has been trying to implement, and in particular Europe. Now, I've spoken about this on the channel, but let me just refresh. In Europe, particularly Germany, the Netherlands, other European countries, they very foolishly and very rapidly went into green energy, and they simultaneously shut down their coal facilities, shut down their nuclear in the case of Germany, and they became very, very dependent upon Russian oil and gas. Okay? They did two things simultaneously at the exact wrong time, as it turns out. So these countries and Europe in general is currently extremely vulnerable to the geopolitical situation. Okay? Their dependence on Russian oil and the confluence of events with the war has been a complete disaster. And when you're looking at potentially selling Exxon, because you're worrying about the US economy becoming soft, you really have to understand this. It's really a structural issue in Europe right now. Not only is there a worldwide demand-supply imbalance, right, of millions and millions of barrels of oil per day, but there is also a structural problem now as Europe tries to wean itself off of Russian oil and gas. Okay? Germany and other, well, I'm just using Germany as a proxy because they're the most extreme example, but all of these European countries have the same issue. Germany's having to refire up their coal facilities. They're scrambling to try to replace gas in particular from Russia. And at least at this point in time, there is no way that the U.S. exporting LNG, liquefied natural gas, to Germany and other European states could ever replace the amount of natural gas that flowed to them from Russia. And I read an interesting statistic. To replace all the LNG exported or that would have been used from Russia, you would have to divert all of the LNG that's exported to both China and Japan on an annualized basis to replace what they are getting from Russia, which of course is impossible. Okay? Not going to happen. So they are in a tremendously bad situation. Okay? Couple things I want to show you here. Let me just tee this up for you. All right. Here's an article I came across. Oil traders in panic after Russia order to halt CPC terminal. Now this is an oil terminal in the Black Sea, and basically regulators shut it down, and it's millions of barrels of Azeri light and other sweet crude products that are being diverted or shut down, basically, depriving Europe of a hell of a lot of oil. Okay, in addition to Russia basically, weaponizing the oil supply, there is tremendous strife going on in Libya. Okay, Libya is on the verge of an all-out civil war, and if Libyan oil goes offline, that's going to be another 1,000,000 barrels a day that will be deprived, that will deprive Europe of even more supply. Okay. If the stoppage occurs in Libya, it would be another blow to European oil market that's lost a large amounts of supply to unrest in Libya and seen sharply reduced shipments from elsewhere. There's a chart here I wanted to show you. Look at this chart. This is the Brent swap market, the Brent oil swap market. Okay, it's been going off the charts, as you can see here, off the charts, and this represents the physical oil market in the European sector. Okay, so a lot of distress being shown in those sectors, and Russia's not stupid. Okay, they know how to play this oil and gas business, and they know how to exact the greatest amount of pain to Europe. Okay, here's another chart. Here's natural gas on the CME. Now it looks like it's come down, but it came down from 9.5 BTUs down to 561. Okay, that looks like it's down, but it was coming from 4 down here. So it's gone from 4 to 561, and you can see the march up, and it's come down. I mean, we're basically in the summer period here. So the concern is that when the winter comes, they're not going to have enough gas to heat homes in Europe. Okay, really a very, very serious and a very disturbing trend. But this is, as I mentioned, this is a structural issue. This is a structural issue, in addition to the demand-supply imbalance. Okay, if you want to be in oil and gas, if you want to be playing this energy sector, it's a global business. Okay, you can't just focus your attention on the U.S. and say, okay, the U.S. economy is slowing down, so that means, oil prices are going to go down. You got to keep your eye on the entire world, and specifically what's going on in Europe. Okay, because the EU and the United States are enormous factors in the world economy. Okay. So that brings us around to the question of, where are we in the cycle? Should we still be bullish on energy? Is the economic slowdown that's anticipated, does it make us feel like we should be thinking about selling Exxon and Chevron and others as we look at this situation and as this situation develops? I am still bullish, and the reason I am is for the structural issues that I just talked about in Europe. Domestically, you still have the same situation politically. You have the Biden administration resolutely against the oil and gas companies, declaring war basically on the fossil fuel industry. That is not going to change. You have historically high supply-demand imbalances. You have refining capacity in the U.S. and elsewhere, very, very tight. They're not going to build any more, in my opinion, they're not going to build any more gasoline refineries in the U.S. or oil refineries in the U.S. So it's not just the discovery deficit, it's also the refining deficit, which is going to remain tight for many, many years. And this particular statistic has to do with the U.S. and Europe. For every 1% reduction in energy supply, you lose 1% of economic growth. Okay, that is a sort of a measure that economists have come up with that I read about this week. So 1% decline in supply can equate to 1% reduction in GDP. Okay, I thought that was a very interesting statistic. There's something else I want to just show you here. All right. And this relates to Exxon. Take a look at this. So Exxon's Q2 earnings could quadruple from last year. Okay? It's projected, and it's very possible, that Exxon's second quarter earnings could top $18 billion. Okay? $18 billion. That is a enormous, stupendous sum, and it speaks to how healthy these margins are in the energy sector. And in another related statistic, I read that analysts are expecting that from their refining business alone, Exxon could earn in excess of $5 billion in the quarter. Okay, that is just absolutely remarkable, and it's something to keep an eye on. Let's see. Now, what I wanted to do is I want to go over to here, and I'm going to try to pull up the Exxon chart. All right, here's the Exxon chart. And, okay, so let's just take a look at this, all right? So this thing has basically tracked, it's basically tracked what the expectations have been in the market for the economic slowdown, right? People started talking about this in earnest right around here in mid-June. It's gone up and down. I guess it closed today at 86, all right? I did a video up here when it hit 104, 105. I did a video, which you should check out on the channel, when it went past 100. And I basically said at that time, I'm still bullish on Exxon, but don't buy it because the price was just so extended. And since then, it sold off about 20%, 18 to 20%, okay? So I think what's happening now is we're at the point where the dividend's over 4%. The price has come down, making it much more attractive. It's hitting this this base here, which may be a resistance point. I don't want to get too technical here, but it may be a resistance point. But I think over a 4% dividend, given the structural issues and the supply-demand imbalances that I just talked about, I think you're still in a very good position if you were to go into Exxon here and buy the dip, so to speak. Okay? So we're looking forward to Exxon reporting. They'll be reporting in a few weeks, and we'll be all over that to check that out. Okay? So I think all in all, the market is trying to figure out what's coming, and a lot of it rests on the market's interpretation of how it's going to affect Fed policy. I tend to think that, number one, it's going to be very difficult for the Fed to micromanage how this plays out. Okay, the Fed is completely behind the curve in terms of fighting inflation. Money supply, before they started tightening, was completely out of control. It had risen over $5 trillion in a very short period of time. I've done a lot of content on this channel related to that. So the Fed has a lot of wood to chop to bring this inflation under control. Okay? I do not think that they're going to be able to fine-tune it in such a way so that the economy has a soft landing. Okay? So far, you're not seeing a lot of damage to the economy about what they've done, and I think it's because they're taking such an incremental approach. They're going so slowly. They started doing 75 basis points of raising the Fed funds rate. I mean, the Fed funds rate right now is 150 to 175 is the range at a time when inflation is officially 8.6%. It's probably 15 to 20%. Okay, they are so far behind the curve, it's absurd and ridiculous. So I think what's going to happen is they're going to have to get very aggressive. But when they see the markets collapse and when they see the economy soften significantly, I think they're going to pull back. They're going to wimp out because I don't think Powell has the gumption or the balls, so to speak. I don't think he's got the balls, to be a little crude here, to really do what's got to be necessary to stop this inflation. Okay, he's no Volcker. He's very political. He didn't seem to understand through the whole period of when he was flooding the market with liquidity and providing easy money for every speculative asset on the planet to create massive bubbles all over the place. He didn't seem to understand that that was going to create massive inflation. Now, how he didn't understand that, he's supposed to be the Fed chairman, I completely don't understand. But that's what we're dealing with. So now supposedly he's gotten religion, and he's supposedly going to be doing the correct things and doing what he needs to do. That remains to be seen. I still think he's going to wimp out at the end and back off. That, of course, is what the market is hoping for, and hope springs eternal. And that's why you see these intermittent rallies when people start talking about recessions, because people believe that he's going to back off if the economy softens significantly. Okay? Well, that's pretty much what I had to talk about today. I hope you got some value out of it, and if you did, please like, subscribe, and hit the bell. I'd love to have you on board on the channel. As I said at the beginning, we talk about the stock market, we talk about investments, specific investment recommendations, as well as macro issues, the economy, Fed policy, and I try to analyze it using my many years on Wall Street and my background as an investor to hopefully benefit you as an investor. And thank you for joining. Have a great weekend, and I'll see you on the next video. And I'm trying to do these live streams every week around 5 o'clock on Friday to the extent that my schedule permits. And so again, thank you, and I'll see you on the next either live stream or video.